Here we go, infinite banking, pros and cons. We are first going to look at the pros of infinite banking and high cash value whole life insurance. When you have a high cash value whole life insurance policy and you're using it for the infinite banking concept, you get guaranteed growth of your money and you're growing money on a compound interest growth curve. The cash value is liquid. There are no surrender charges in a whole life policy, so the majority of the premium that you're putting into the policy goes straight to cash value, and you can begin to access policy loans definitely in the first year. High cash value whole life policies have tax advantage growth, and I teach you how to use that money completely tax-free. There are flexible premium options, meaning you're not locking into the same premium payment every month or every year for the rest of your life. There will be minimums and maximums, and you'll be able to go up or down depending on your financial goals. The policy in the infinite banking concept is not tied to the stock market. There are no losses. You make money every single year. There are high contributions allowed. There is what's called the MEC limit, we'll get into a little bit later. I don't want to say that these are unlimited contributions, but they are virtually unlimited contributions. They don't have the restrictions like an IRA or a 401k. There are collateral opportunities. I can teach you how to collateralize your death benefit to become a more advantageous borrower with a bank. Oftentimes, real estate investor clients of mine will put their death benefit up as a collateral assignment to borrow more money to purchase more real estate. Policy loans allow you to purchase assets and to pay off debt. This is a huge feature of the infinite banking concept, that you can take policy loans tax-free and go buy more assets to create more wealth. When you have a policy loan, your total cash value grows despite the policy loan. In other words, you're still earning interest and dividends on your total cash value, even though you have a loan. So if you're a real estate investor or a business owner and you take a policy loan to invest in real estate or in your business, you're making money in two places. You're still earning interest and dividends on your total cash value, and you're making money in the real estate deal or your business. And take a look at this chart. I'm comparing a 529 plan, a 401k, or a 403b, an IRA, and a Roth IRA, all to a cash value whole life insurance policy. So the first thing you see there, tax-free access to cash. You don't get tax-free access to cash on any of those, maybe in a Roth if you follow the plans after the age of 59 and a half. But tax-free access to cash is always available in your cash value whole life policy. And then going down the list, guaranteed predictable growth. Those don't happen in a 401k or an IRA. You don't have full control of your money without government restriction or penalties in a 401k or IRA. Tax-free retirement income. When you take money out of your 401k or IRA in retirement, it will be 100% taxable. In a whole life insurance policy, you lock in your principal and growth, even if the market crashes, because it's not tied to the market. If you have gains in your mutual funds, ETFs, or stocks within your IRA or your 403b or 401k, you can lose those gains. There's also optional disability waiver with a whole life policy. You can use your money in the plan without the penalties. And this plan finishes funding itself if you die prematurely, because there is a death benefit that's permanent. You can use the money in the plan, as I mentioned earlier, and still have it grow, though you didn't touch it. If you take money out of a 401k or IRA, that money's gone, no longer working for you. A policy also, in most cases, doesn't affect financial aid. On the FAFSA form, you don't have to report your cash value life insurance policies. And because of the guarantees, you will know the minimum guaranteed value on the day you tap into it and at any point along the way. This is really important for retirement. If you're crossing your fingers and hoping that your 401k or IRA works out for you, there's no guarantee that it will. There are living benefits in a whole life policy for terminal illness, chronic illness, and critical illness, and most of the time those riders are free. As I mentioned, virtually no contribution limits in a policy where you do have restrictions in the government qualified plans. And yes, a permanent death benefit that you can use for legacy planning and estate planning. What is infinite banking? It's a uniquely designed, properly structured whole life, high cash value insurance policy. And it must be with a participating, dividend paying mutual life insurance company. It's a system for people to become their own bank by taking control of the banking function in their lives. Nelson Nash created the concept in the 80s and wrote the book, Becoming Your Own Banker. There are other names for infinite banking or IBC, bank on yourself, wealth maximization account, cash flow banking, private family banking. But be aware, just because you might see one of these names doesn't always mean that you're getting the right policy or the right company or the right design. So there's some key things that you must understand in order to take advantage of the pros of the infinite banking concept. Some of those goals for a properly structured high cash value whole life policy used for infinite banking are maximize the cash value growth. We do that through what's called the paid up additions rider or PUA. Minimize the insurance cost. You want to be sure that your base premium is as low as possible. This minimizes the insurance cost. And I teach you how to use the policy loan feature to generate more wealth. What are the downsides of the infinite banking concept? It's not a short-term investment. If you come to me and say, Barry, I want to work with you and invest money for 3 or 4 years, I would tell you more than likely this isn't going to work for you. Can you set up a single pay policy and make a one-time premium payment and never have another premium payment thereafter? Yes, you can. But in those cases, a single pay policy does not grow tax-free. It grows tax-deferred, and you can use the money tax-deferred, but not tax-free. You want to be thinking about the infinite banking plan designed to fund for at least 7 years. 10, 15, 20 plus years is better. But what you don't have to do is fund it for your entire life. Because of those flexible premium options, you can choose to stop at a given point, but you should plan to fund at least 7 to 10 years. Not 100% of your premium is available in cash value in the first year. Depending on your goals, you'll see 70 to 90% of your cash value available in the first year in most cases. Again, the majority of your premium goes to cash value, not to buy a bunch of life insurance. There are interest charges on policy loans, and that interest does go back to the insurance company. However, as I said earlier, when you take a policy loan, the insurance company doesn't physically remove that money from your policy. So although you are being charged interest, you still earn interest and dividends on your total cash value. A whole life policy requires an application and qualification. You must qualify for the policy. And not everyone's going to qualify. We're going to do the best we can to get you qualified. Your health, age, lifestyle, and income are going to determine what you get approved for. Do not use IUL for IBC. IUL is Indexed Universal Life Insurance. The reason not to use IUL for IBC, number one, is because IUL does have surrender charges, meaning your cash value is not all available to you for 10 plus years because of surrender charges. There are increasing insurance costs in IUL. Indexed Universal Life is built on the chassis of annual renewable term insurance. What that means is the older you get, the higher the cost of the insurance. IUL illustrations show unrealistic returns. What I mean by this is they only show the market index making money. The illustration doesn't account for any losing years. But we know because the IUL is tied to an index, there are going to be some years where the policy doesn't make money. The IUL illustrations only show you making money, but we know that is not how the stock market works. There will be volatility, there will be gains, there will be losses, but the IUL illustrations don't show it, they don't account for it. So when you look at an IUL illustration, it looks amazing, but it's unrealistic because they are showing you as if you are going to make money in the market every single year for the rest of your life. How to capitalize on the infinite banking concept and establish a plan. The first thing that you want to determine is how much premium do you want to put into a policy? $10,000 a year, $25,000 a year, $50,000 a year, $100,000 a year, and you want to add any lump sums on top of that that would go into the policy with the first premium payment. That's up to you. I recommend around 10 to 15, maybe 20% of your gross annual income to go into a policy. And in establishing a plan, I design your illustration numbers for you. The goal, as I mentioned earlier, is to maximize your cash value. We do that through the Paid Up Additions Rider, PUA. You want the majority of your premium going into PUA to build up as much cash value possible, and you want the least amount, the minimum amount of your premium going into base. Well, there's a problem here. If we're minimizing the whole life portion of the policy, we run into a problem with the MEC limit. So the way that we raise the MEC limit is by adding a term rider to the policy. The term rider enhances the policy, it's lower cost, it raises the MEC limit, and it allows you to get more cash into the policy. This is a properly structured IBC whole life policy design. These are key features that must be included in order for you to get the most optimized policy. You see, most life insurance agents out there don't know about this, or if they do, they don't want to put the least amount of your premium into base. Why? Because it dramatically reduces their commissions. We as life insurance agents and advisors are paid primarily on base premium. So the design is key for you to get the best policy to meet your high cash value goals. Let's look at a real life illustration designed for high cash value growth and how the policy will be used for infinite banking with policy loans. This policy design is on a 37-year-old male in good health. He's putting $25,000 a year into the policy, and in year one, he's going to do an additional lump sum of $75,000. So when we look at the contract premium in the first year, you see the $100,000 total going into the policy. The goal is maximum cash value and a minimum death benefit, or the minimum amount of his premium going into the base. In a traditional old style whole life policy, or even an IUL, you would have very little access to cash value. But in this case, you'll notice in the net cash value column, there's over $94,000 of his $100,000 premium going directly to cash value. That's over 94% of his premium in cash value. We are looking at the non-guaranteed values, which include the dividend. You see the dividend column here. Dividends are growing every year because dividends are paid on total cash value. The guaranteed cash value does not include the dividend. The companies that I use are the top mutual insurance companies in the industry. They've all paid dividends every year for over 100 years. We want to look at the non-guaranteed values that do include the dividend. They are more accurate. You'll notice a $1.5 million death benefit in year one. However, he's only purchasing $105,000 of actual whole life insurance. The remaining death benefit is coming from a 7-year term insurance rider. The 7-year term insurance rider is added to the policy to raise the MEC limit to allow more cash value growth in the policy. The term rider enhances the policy. It's a lower cost, but because the MEC limit is higher, you can get much more cash value into the policy. Every year thereafter that you see the $25,000 premium going in, the cash value begins to grow by more than the $25,000. And we see that in this column called increase in net cash value. So in year 3, he put in the $25,000, his cash value grew by $28,275. In year 5, he put in the $25,000, his cash value grew by $31,321. In year 8, he put in the $25,000 and his cash value grew by $36,756. And these numbers, as long as he's making a premium payment, will always increase. Notice in year 8 that the death benefit reduces from $1.9 million to $719,000. That's because the 7-year term rider is no longer needed. We drop it off the policy. But remember, How much whole life insurance did he actually purchase? Only $105,000 of death benefit. But what he gets in year 8 is about 7 times more than he paid for. And every year thereafter, his death benefit will also continue to grow. This is a permanent whole life death benefit. It won't expire. So whether he passes away at the age of 85 or 105, there will be a permanent death benefit there that he can use for legacy planning and estate planning. Because we're talking about cash value growth and the infinite banking concept, the benefits and pros of infinite banking, we're going to focus on this cash value column. And every year, as I mentioned, the cash value gets larger and larger because of the compounding. This is a flexible premium. You notice here, after 20 years of putting in the $25,000, at year 21, the premium reduces to $4,689. He could fund only $4,689 in the earlier years if he wanted to. The goal is to fund the $25,000 as long as possible, as long as you have income or you're working. Keep putting in the maximum premium, because with that paid up additions rider, the majority of your premium is going directly to cash value. And for example, in year 14, if your cash value grows by $47,000, almost double your premium, why wouldn't you keep doing that? And you really see the power of the compound interest here. The other great thing is because he put $100,000 into the policy in the first year, he could continue to put in $100,000 at least through 7 years if he wanted to. We're not illustrating that here, but one of the benefits of high cash value whole life is that you can keep funding the same amount that you put in the first year. If the policy is structured correctly, that allows you a really wide range of premium flexibility. So in his case, he could go as low as roughly $5,000 a year, all the way up to $100,000 a year, or any amount in between those two numbers through the 7th year. But let's assume in year 4, he's sitting on $179,000 of cash value, and he wants to take a $100,000 loan because he's going to invest in a real estate property. He'll use that for the down payment portion on the real estate. It's very simple to take a policy loan. He calls the insurance company or makes the request online. There is no credit check. There is no application. And the insurance company doesn't question him what he's using the money for. They don't care. And the reason they don't care is because if he happens to pass away with a $100,000 outstanding loan, that will simply be deducted from his $1.7 million death benefit upon his passing. So with the $100,000 loan, it's going to be deposited directly in his bank account within 3 to 7 business days. One of the huge benefits here is that although he has a $100,000 loan, he is still earning interest and dividends on his $179,000 total cash value. It's unaffected. He makes money on his total cash value whether he has a loan out or not. He gets to choose how he pays the loan back. He can pay it back in a balloon payment. He can pay it back monthly starting 30 days after he took the loan. He can pay it back annually. It's really up to him. And because this policy functions as his own bank, he gets to choose how he pays the loans back and can even change the loan terms during the loan. The interest that's charged today is roughly 5%. That 5% interest does go back to the insurance company. But as he's paying down the loan, the balance of the loan is going down. We call that principal reduction. So he's paying less interest over time. However, his total cash value of $179,000 is still compounding. It's still earning interest and dividends. So if he's paying 5% interest, and if he's earning a 5% rate of return tax-free in the policy, that 5% is compounding. So although it might seem like a wash at face value, 5% being paid, 5% being earned, he still comes out ahead because of the compound interest earned on his total cash value. I recommend that you also watch my other Infinite Banking webinar where I discuss policy loans in greater detail. We go through the math and you'll see using calculators how you come out ahead when you take policy loans. Remember, there are multiple benefits of high cash value whole life insurance and the infinite banking concept. The top 3 benefits: guaranteed compound interest growth, access to liquid cash for infinite banking, and tax-free use of that money. I would invite you, look at your own numbers, see how a high cash value policy and the infinite banking concept will help you, will benefit you, will allow you to grow more wealth throughout your life. You can email me, call my office. I look forward to talking with you. Let's look at your own numbers and see how a properly structured whole life policy will work for you.